And it does seem like the market is also gearing up for what we will hear from Jay Powell, the head of the U.S. Federal Reserve, who is navigating the Trump tariff uncertainty and what that means for the U.S. economy. Let's bring in Thierry Wizman, FX and rates strategist at Macquarie Group, for his perspective on what to be watching, particularly in the currency market. Obviously, you track it so close to Terry. Give us a sense on currently what the market is betting Jay Powell will say this week.
We know one thing for sure, that the Federal Reserve is not going to do anything with interest rates this week. They're going to stay on hold with regard to the Fed funds target. I think, however, that based on what the forward pricing has been over the last 2 or 3 weeks, the market is certainly expecting, or at least hoping, that he will guide that towards lower interest rates over the course of the next few months. If you had looked at the swap market, for example, as of yesterday, you would have seen that it was projecting implicitly somewhere between 2 and 3 25 basis point cuts between now and the end of the year. So not only is that what it's anticipating, but I suspect that's also what traders are hoping for. The problem, of course, is that it should not be as crystal clear as that. I think, as you mentioned earlier, the Fed is going to be contemplating what conceivably can come out of the tariff situation. And of course, there is the prospect that inflation is already rising a bit in the U.S. because of supply pressures and demand pressures, by the way, having to do with the anticipation of prospective tariffs in the U.S. So he's confronted with the possibility that inflation has stopped coming down, that the disinflation process has stopped effectively. But at the same time, of course, there is the effect of the earlier interest rate hikes on the consumer. There is clear evidence in the U.S. that the consumer is slowing, that he's becoming a bit more reticent to make discretionary spending decisions. And as a result of this, I have a suspicion that the Fed is simply going to do what other central banks have done in the last few weeks when they've met. The ECB, for example, has refused to offer guidance. The Bank of Canada, your own Bank of Canada, has also chosen not to offer much guidance going forward. We suspect the Bank of England is going to do the same, and we suspect the Fed is going to do the same. Now, from the perspective of the market, that might be a disappointment for traders that are hoping for 2 or 3 more rate cuts this year and not getting confirmation of that from the communications that Powell is going to issue this week. It could be a bit of a disappointment.
So the market went from wondering whether there was a so-called Trump put to maybe being curious about whether there's a so-called Fed put, and it sounds like you're saying that that could prove to be elusive.
It's certainly not clear from my perspective, and I don't think it should be clear from the perspective of Federal Reserve policymakers either. Of course, there's a spectrum of opinions on the Fed, but I suspect that it's very possible that the doves might get more dovish and the hawks might get more hawkish in view of the way that they're interpreting the current data, which is not clear-cut either by way of the inflation or the activity levels in the U.S. There are mixed signals. There are signals that seem to suggest stagflation, and it's not really the Fed's job to address issues in the market that pertain to stagflation. The Fed is much better suited to addressing issues that have to do with inadequate demand, for example, or too much demand that leads to inflation. We're not really seeing that now. We're seeing a bit of inflation, but also a bit of activity weakness.
Terry,
and sometimes you just have to stand pat.
No kidding. Let's talk a little bit more about the appetite for the U.S. dollar these days. Obviously, there's a lot to unpack when it comes to currency flows, but we've spent a lot of time this morning talking about gold's record high, and even some strategists saying they're squarely watching the currency story to determine what happens with gold as well. Give us a sense on how the market's mood around the U.S. dollar is these days. I mean, we're certainly watching it just in light of a weaker Canadian dollar as well.
And look, I think it stands to reason that there's been a very big sea change in the way that the market perceives the dollar. And ultimately, that has really nothing to do with changes in central bank policymaking, either in the U.S. or offshore. Central bank policymaking has become very derivative of what's happening in the country capitals, whether it's Washington with regard to tariffs, or Brussels and Berlin with regard to German fiscal policy. So central banks are taking a back seat right now. As far as how that pertains to the dollar, the market has all of a sudden bet on the premise that the U.S.'s role in providing the provision of global security will be in retreat over the next few years. And that in conjunction with that, and this is most important, the Europeans are going to be spending much more on defense, on infrastructure, on the digital economy. Their deficits are going to go up. Their bond issuance is going to go up. And at the same time, it's very possible that we're going to get some traction in Washington in deficit reduction in the U.S. That makes for a divergence in fiscal policy, and standard economic models suggest that when that happens, yields will go up much more in Europe than they will in the U.S. It will draw money market inflows and bond market inflows into Europe. That will strengthen their currency. And that's effectively the reason why the dollar has been so weak compared to the euro. I think the story with regard to the Canadian dollar is a little bit different. It doesn't have much to do with fiscal policy. It has a little bit more to do with the prospect that we could see some pro-growth measures come into Canada under a new government. That would be good. That would also strengthen the Canadian dollar. But there's a lot of bits and pieces floating around of stories that are not supportive of the U.S. dollar right now. What's happening in Europe is the most prominent, though.
That's a very helpful connecting of the dots. Real quickly before I let you go, can you just sort of set the record straight on what the Trump administration has said at this point with respect to the levels of the U.S. dollar and how much you would be paying attention to those comments?
One has to pay attention to those comments. And most of the things that have been issued by the U.S. have really come out of the Treasury Department under Scott Bessent. And I have a suspicion, based on my reading of what Scott Bessent has said, is that although the U.S. wants to promote export performance out of the U.S. and may want to reduce the U.S.'s trade deficit, the first order of business is not to weaken the dollar in order to do so. The first order of business is to try to convince other countries to remove their tariffs and prospectively make U.S. goods more competitive. However, if that doesn't work, and if the U.S. has to go to a plan B, that plan B might be to try to weaken the dollar, and might be to try to convince other countries as well to join in that imperative. But right now, I don't see that as the plan A. And the reason is very straightforward. Inflation under the Biden administration is one reason why the former administration in the U.S. lost so much political capital and effectively lost the election to President Trump. I don't think that he's of a view at this moment to jumpstart more U.S. inflation by weakening the dollar.
All right. Helpful context there. Terry, thanks very much. Thierry Wizman of Macquarie Group on what to be watching with the U.S. currency. And of